No, you're absolutely right. Back in 2016, we were faced with the prospect of interest rates going up. I remember at the beginning of 2016, it looked like the Fed was going through a tightening cycle. Boy, things have changed. This
Yeah.
is a completely different dimension from what we saw back in 2016. I think the Fed came out the other day saying that basically there's no prospect of interest rates going up till at the earliest
Denver.
23. We're not even thinking about it. That was Jerome Powell's quote.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. On the road again today from Minnesota, and certainly been interesting in seeing the city and the things that are happening in life, along with the things that are happening in the gold and silver markets, which makes today quite exciting to welcome a new guest to the show, David Garofalo of GoldMining, who has quite a background in the industry, especially with a lot of new people being exposed to gold and silver. I don't know if it's a stampede yet, but there's definitely people in the mainstream that are coming to this sector that have not heard about many of the things that happen in the gold and silver business. So David, it's a pleasure to welcome you on in here today. How's everything going with you?
It's great. Thanks for having me on, Chris.
Well, it's a pleasure to have you here, and perhaps maybe to set some context, if you could let people know a little bit about your background. You've been doing this for a while. You've seen quite a lot in the mining world. You know what to look for, what to watch out for, all those things that can save people a lot of money and time and effort and frustration. So maybe you could start there.
Well, I've been in the mining business for about 30 years, about half of that in the gold business, half of it in base metal. I've run both a base and precious metal company. Most recently, I ran Gold Corp, which was one of the top 5 gold producers in the world. Merged it with Newmont last year, creating the world's biggest gold company with over 6 million ounces per annum of production. And before that, I was running a base metal company called Hudbay Minerals for about 6 years, tripled the size of that. And over the course of my career with the 4 companies I've been with, including Agnico Eagle, and before that Inmet, I've been involved in the construction of about 12 or so mines around the world. So I've been really building businesses from the ground up, quite literally, within the mining business, both on the gold and base metal side.
Yeah, and David, could you ever imagine that we would finally reach that point where a lot of people who got into gold and silver throughout the past couple of decades because they saw the debt loads, they saw money printing growing and growing throughout all the time that you've been doing that, it's kind of like we've expected this, yet here we are now.
Yeah, we've been through gold cycles before. I think what's unusual about this is the coordination among the central banks globally. We haven't seen that before. Really, that the advent of that was the credit crisis about a decade ago, where central banks started to cooperate with each other. Now they're coordinating their efforts in terms of introducing stimulus, in other words, printing money. And so that's happening globally. And there's a competitive devaluation of currencies going on to preserve export markets to amplify that. And the reality is both governments and companies are strapping on debt to unprecedented levels that they can't hope to pay back. And so really what the governments are trying to do is inflate their way out of debt. Who would have thought 10, 15 years ago that central banks would be buying corporate debt instruments in order to preserve credit markets, to keep them moving? That's not what central banks are supposed to do. They certainly shouldn't even be buying sovereign debt, but they're doing that in an unprecedented fashion as well. And the way they're doing that is by printing money. And paper money is infinite in quantity. If you've got a printing press, you can create money. You can create the illusion of value. And that's really what paper currency is and fiat currency is. It's the illusion of value, but it isn't underpinned by anything. And that's true for Bitcoin as well. There's just zeros and ones. There's no intrinsic value in these instruments. The only true currency is gold and has been for millennia. And there's a finite quantity of it. You can't print it. There's 200,000 tons of gold on the Earth's surface that's been mined since the beginning of time. You could fill 4 Olympic-sized swimming pools with that. That's it. And so when we're seeing this rush of paper come into the market, it's like a herd of elephants trying to go through a keyhole. The door is going to come off its hinges.
Yeah, and I think it's great what you just said, and we'll touch on how that could even apply more so to the silver market. Although before we dig into silver, I mean, it's interesting because as we talked about before we hit record, for gold in particular, we're not talking about one day or maybe these gold bugs will be right or maybe they'll keep printing money. I don't know. I think it might be 27 trillion on the publicly stated debt, or you never know when it jumps a trillion or two unexpectedly. But I mean, even at $1,900 gold, the Fed is talking about they just tacked on another year of 0% interest rates. So it's like, even where we are, what else can you expect to happen going forward?
Yeah, interest rate levels have become irrelevant now. You're at zero, and so that means what they have to do is print money and buy corporate credit instruments, buy sovereign debt. That's really the barometer. Is money supply is a barometer of what's going on right now, and gold is a barometer of that. It's indicating to you that paper currencies are being depreciated in value through the printing presses, and that's really what's driving the gold price. But if you look historically at where gold has traded, we're still not at real peaks. Gold in 1981 was $850 an ounce. That was the real all-time high. In today's dollars, that's about $3,000 an ounce. So it's not a coincidence that Merrill Lynch came out a couple of months ago saying that's their target for gold, because that's the real all-time high. They didn't just pull that out of their hat.
Yeah, and I've actually heard David Morgan talk about silver. If you use the old CPI formula, that it clocks in at about $600 an ounce, which it's nice even seeing the smile on your face. And I think everyone at home listening, like, wow, that would be, a nice target. Although I know you have some thoughts. You've studied the silver market quite a bit, and it certainly seems, I don't know, maybe one day we will print that much money. Yet even now, gold's past double its 1980 high, past its 2011 high. Silver at $26, $27. It's been floating around. What do you see happening there, David?
Well, I mean, historically, in a bull market for precious metals, the gold to silver ratio, the price of gold divided by the price of silver, is typically 40 to 1. Right now, we're at 70 to 1. What that indicates to you is if you're a bull on gold, then silver will increase twofold over what gold will increase percentage wise to get aligned, with historical ratios between the gold and silver price. So it's not, if you believe gold's going to 3,000 as Merrill Lynch is expecting, then you shouldn't be surprised to see silver at triple and plus where it is today.
Well, that would certainly make a few people watching today happy. And, I try to be responsible in terms of not giving wild numbers yet. Again, it's like I just don't know what else people are. Do we buy Tesla shares that are up tenfold since last September, or negative yielding treasury debt while the Fed the next scheme is to raise the inflation target? I mean, it's like, what are the choices that you have?
Yeah, and look, and I think gold equities are compelling value, and they've only just reached the peaks that we enjoyed 10 years ago when gold was $1,900 an ounce. But the difference today versus 10 years ago is gold companies are vastly more profitable than they were 10 years ago, and they're vastly unleveraged. They've generated so much free cash flow the last couple of years. This is a sector that has virtually no debt, and the cost structures are that much more stable because we don't have the super cycle. And the super cycle 10 years ago was driving base metal prices to unprecedented heights. And that resulted in a gallop towards growth in the mining sector generally. And we saw vast cost inflation. So that really eroded away the multiples, even as the gold price was going up. That's not happening now. Cost structures are very, very stable because base metal companies are not doing very well. Base metal prices have been largely muted because of the underperformance in the general economy. And as a result, input costs are flat. Local currencies are depreciating. So if you're producing gold in Australia, in Canada, in parts of Latin America, your local currency is weaker against the US dollar than it was 10 years ago. So your local costs are down. And the other thing is a third of our costs are energy. So this is a very energy intensive business. We use a lot of diesel, for example, we use a lot of power. Well, those prices have been stable to down. And so we're actually seeing costs go down as the gold price goes up. So margins are expanding quite significantly. So the leverage proposition to gold is dramatic. Now, if you're looking for even more leverage, what you want to look for is development stage assets. And reserves in the gold sector are down 50% over the last 7 years. So we've been depleting ourselves out of existence because we haven't redeployed capital into exploration to replace what we're producing. And so you've got to look at development stage companies like GoldMining, where collectively we have 25 million ounces of gold in the ground. That's significant. That would make there are senior companies that don't have that much reserve in the ground. We have 25 million ounces of undeveloped reserve and resource within our portfolio of gold mining. Well, the seniors are going to have to start to look at companies like us in order to replace what they're depleting because they're not exploring. They've outsourced that to companies like us. And we've inventoried at very, very low cost these 25 million ounces across a portfolio of 14 different deposits. So we're quite diversified. And we have very large deposits, we have medium-sized deposits, and we have smaller deposits. So really, it's not one size fits all. We can appeal to a broad array of producing companies from big to small that need to replace their reserves, and we can partner with them to further develop our projects within gold mining.
Yeah, I appreciate you mentioning that because I was wondering if you could help put it in context where, I mean, let alone if we do see $3,000 gold, which when you just look at the money supply seems somewhat inevitable, but we'll just be a little bit more conservative. Even if the gold price stays where it is now, I found it funny. A couple of the mining companies that I brought on, like they couldn't keep up. They're like, all right, at $1,500 gold, it looks like this. Then they're doing the 1,700 projection, and the price rose pretty darn quickly over that past year. Can you put into perspective for folks that just with the price staying where it is now, how that affects some of these companies?
Well, in the case of gold mining, we're trading at about $15 to $20 per ounce in the ground. And typically producers are getting well north of that in terms of the ounces they have in the ground, hundreds of dollars per ounce. And we're in stable jurisdictions. So we're a very, very cheap alternative and a cheap entry point to get that leverage to the gold price. That's the appeal. And because, again, we don't have all our eggs in one basket, we have a diversified portfolio of development stage assets. You're not having to face a multi-billion-dollar project construction ticket on any of these projects. We have large, small, and medium-sized development stage assets that can appeal to, as I said, a broad array of producing companies. So if you're looking for leverage to the gold price, you're going to get it within gold mining, particularly, again, as the senior companies and the established producers turn their sights on what's next to replace what they're depleting, because their production profiles are inevitably declining. If reserves are down 50% over the last 7 years, that's a leading indicator of what's going to happen to the production profile for the gold sector unless they start reinvesting in developing new mines.
And you also have some silver exposure in there, which perhaps you could touch on that for a minute.
Yeah, for sure. If you look at our gold equivalent, which includes the silver, we're closer to 30 million ounces of gold in the ground. So we have 5 million ounces of gold equivalent, largely in silver within as byproducts within our portfolio of development stage assets. And then what we've also done to daylight value more recently, and this is the vehicle that I'm running, is we've created a royalty vehicle. We've written royalties, in other words, royalties as a percentage of revenue, 1% to 2% on each of these development stage assets, and created a privately held royalty vehicle, 100% owned by GoldMining, that we intend at some point to spin out, take public, merge maybe with another royalty player out there. We're looking at ways to maximize value for our shareholders. And that's been partly behind the appreciation we've seen in the stock price of gold mining recently, is the anticipation of unlocking value in that royalty portfolio. And royalty companies trade at vastly higher multiples than gold equity companies do, particularly because they're not taking development risk. And so that's what we're trying to create, is the new royalty vehicle in the gold space. But that's underpinned by a significant portfolio of development stage assets, as I said, 25 million ounces in the ground. And that will unlock value for the gold mining investors.
Yeah, and we have the chart pulled up here. Seems, as you can see, done quite well during the rally. And folks on Yahoo, you can find that at gold.to. David, I actually got some questions this morning about the royalty model.
Sure.
especially a lot of folks new to gold and silver. Can you give an explanation of how that works and what people are looking at with a royalty deal?
Well, typically royalty companies, because they're not taking operating risks, they're not taking capital cost risks, operating cost risks. Really, they're getting a percentage of the top line. They generally tend to trade at a much higher multiple than typical gold producers do. Sometimes 2 to 3 times the multiple. That means the cost of capital for these royalty companies is much, much lower than it is for producers, particularly when you compare it to, say, base metal producers, but certainly true relative to gold producers as well. And that, at the risk of being a bit esoteric, is an arbitrage opportunity. If you can get capital cheaper than mining companies, and you can tap into the equity markets, tap into the debt markets at a much lower cost, you can then redeploy that capital into miners, either to help them uh, uh, optimize their existing operations or build a new project. It's a source of capital for them, these mining companies, because they're trading at significantly lower multiples than the royalty companies. So we effectively act as a bank. We take capital from the market in the form of debt and equity, and then we redeploy that into producers at a much higher cost and create a significant margin for our investors at a much lower risk proposition, because again, we're not taking the capital expenditure risk associated with mining, the operating cost risk associated with mining projects. We're just taking the top line.
Yeah, which makes a lot of sense. And it's a nice profile. Again, there's all sorts of different types of mining stocks that, depending on what someone wants, and certainly appreciate you explaining that about the royalty model. We actually had Amir on a couple weeks back, and he was talking about the company. And when we wrap up, folks, that will be linked right there. So if you'd like to hear from Amir himself, you can do so. Although, David, anything else about gold mining or the industry that you'd like to share today that folks would be well served to know, as we see, a current gold price of about $19.50 an ounce, and anything else you'd like to share there?
Yeah, no, I think the important point, and we're going to reemphasize that, is if you want outsized leverage to the gold price, you want to buy into development stage and exploration stage companies. While the producers have essentially achieved their peak levels or peak valuations that they achieved 10 years ago when gold was last over $1,900 an ounce, the developers and explorers are still at, on average, less than half of where they were a decade ago. So they've got quite a bit of runway here. Even if you don't believe the gold price is going to go up much further, if you think it's going to stabilize at these levels, these companies still have a significant valuation gap to close relative to the producers. And the producers have to buy the developers. They have to. Mining companies and operating companies in particular are a collection of finite life assets. Every day that they mine an ounce of gold, they're dying a little bit. And so if they're not reinvesting back into the ground, they're going to see their production and reserves exhausted, depleting. So they're going to have to deploy capital into these development stage and exploration stage companies like gold mining. That's the opportunity. And gold royalty will offer another dimension of value creation and leverage for gold investors. If they invest in gold mining, they're not just getting the development stage assets that we have, those 14 development stage assets with 25 million ounces of reserve and resource, but you're also getting this royalty vehicle that'll likely be optimized in the market through a spin out, IPO. We're looking at a number of options. And so you're getting that royalty company for free.
Yep. And David, does it seem to you like there's still a little bit of that, as we know from Wall Street, well, I'll wait. I don't know if everybody else is buying it yet, so I don't want to be the one guy to do it. And then bonus time comes along, and if it goes, it feels to me like there's still a little hesitation. People are wondering if it's a false start like 2016. I don't know, to myself and a lot of the folks who watch the show, we sit there, watch Jerome Powell. I don't know what else he could do to convince people yet, although it seems like still it's early in terms of the funds really jumping in a big way. What have you been seeing there?
No, you're absolutely right. Back in 2016, we were faced with the prospect of interest rates going up. I remember at the beginning of 2016, it looked like the Fed was going through a tightening cycle. Boy, things have changed. This is a completely different dimension from what we saw back in 2016. I think the Fed came out the other day saying that basically there's no prospect of interest rates going up till at the earliest 23. We're not even thinking about it. That was Jerome Powell's quote. And so,
Yes.
we're in an easing, quantitative easing, stimulative environment for the foreseeable future. That's different, and it could be well beyond that, because the levels of debt that we're strapping on individually, corporately, as governments are unsustainable. The only way to deal with that debt is to inflate our way out of debt. So that means that we're going to see gold run for quite a while, in my view.
Yeah, I sure agree. And David, it is incredible that he actually did say we're not even thinking about raising rates. We have former Fed Chairman Ben Bernanke doesn't understand gold, doesn't have any friends who do either. Thought subprime was contained. So I appreciate you joining me on the show. And especially that you're not just hopping out of left field saying this. You've been doing this. You've been seeing the insides of some of the larger gold companies out there. So perhaps just in wrapping up, you could let folks know how they could find out more about gold mining if they would like to get some info there.
Sure, it's goldmining.com, but also we're listed on the Toronto Stock Exchange, gold.to, GOLD, so easy to remember. If you go on the gold mining website, which you see up on the screen here, you'll also see news about Gold Royalty Corp. You can see there's a tab there. So that's, again, 100% owned by gold mining. But our intention is to eventually take this to the market. And if you're buying gold mining, you're getting Gold Royalty for free.
Well, David, I appreciate you sharing that and joining me. Also appreciate you doing what you do. I know mining, anything in precious metals, it's a little bit of a unique profile where you have to be the guy in today's world that has some patience, where so much of it is thinking about next 10 minutes or next quarter. So thank you for joining me here today. And folks, if you would like to hear more about gold mining, we had Amir on the show a couple of weeks ago, and that interview is coming your way now.